Digital asset investors, Web3 CEOs, are you diving into the world of digital assets and transacting on chain, but getting concerned about the tax implications and worrying that you're going to be target of the next audit? Fear not. In this video, we're going to go over how to prepare for a cryptocurrency and digital asset tax audit in 2024. So firstly, what you need to understand is that it's imperative that you file your taxes appropriately with the IRS. There are several negative tax implications to compliance issues with the IRS that include interest and penalties, cash flow issues related to unexpected tax liabilities, and just overall administrative burdens related to audits and increased scrutiny. So it's key to understand that when you're transacting on a blockchain, you're transacting on a public, immutable ledger that is usually not anonymous and is sometimes pseudonymous, but all a taxing agency has to do is tie your identity to any non-custodial wallet, and you will be on the hook for these transactions. So it is important to understand that there's serious consequences for underreporting or inaccurately reporting your taxes, and that your transactions on the blockchain are going to be there for tax authorities to review in perpetuity. So now, what are the keys to preparing for an audit? I usually say that an audit is one before it starts, and that's because the key is in preparation and documentation in your overall accounting and tax process leading up to you filing your return. If you take the correct steps and you get audited, you really should be able to go into that audit with a low level of concern because you're expecting to leave the audit without any tax adjustments. But there are going to be several steps that you have to take to achieve this. This will include doing due diligence on your cryptocurrency accounting and making sure that you don't just blindly rely on a software, plug your wallets into it, and then file this with the IRS. That is a recipe for disaster. So what are some of the due diligence checks that you need to do once you've set up an accounting system and you're maintaining that accounting system and you're reconciling a year before you file it? There's many checks that you need to do. The first one is on the asset pricing, especially for more obscure assets, to make sure that you're applying the correct evaluation to each transaction so your cost basis and proceeds are accurate for tax purposes. You need to look at the overall categorization of your transactions to make sure that they're just accurate related to the facts and circumstances, but that also you're applying the correct tax treatment in scenarios where there may be some regulatory ambiguity. One that is pretty common that people are aware of is that on your gain or loss report, you shouldn't have any unmatched transactions, meaning you should have a proceeds and a cost basis associated with every transaction, with few exceptions. So to the degree that anything's unmatched, that's indicating a discrepancy that you would also want to investigate. A big due diligence check and a large discrepancy that's very common for me to see with prospective clients that come with CPA, because it does go overlooked, is comparing your calculated ending holdings to your actual ending holdings. With this comparison, if something is overstated or understated between the two, this is indicating that there's a issue in the integrity of your accounting and that that specific asset needs to get investigated further so you can properly reconcile it to ensure accurate tax reporting. The reason why this particular due diligence check is extremely important is because this can impact the accuracy of your current tax year that you're filing and doing the accounting for, but it also can impact future years as well, because your ending cost basis is the starting point for next year's calculation. So there's a cumulative nature to tracking your cost basis on a yearly basis. Lastly, when you're taking all of these steps, especially when you're dealing with transactions that are not totally clear from a tax perspective, we want to document our tax positions and do so contemporaneously, meaning during the time of the transaction, or at least during the time that you're reviewing it with your CPA. this will go a long way where if you do get audited and a tax position is questioned, having this contemporaneous documentation, as long as this documentation is well written and has sound logic and reasoning behind it, this can also go a long way in substantiating your position during the tax audit. So this is something else that you want to build into your documentation process and your accounting system. So setting up these initial due diligence checks is really just ensuring the integrity of your accounting, the accuracy of it, which in turn is going to help protect you from negative consequences related to an audit. So you also want to make sure that you avoid some of the biggest mistakes that are common during an audit. These are essential to avoid, and these are going to be the types of things that I see commonly done from, speaking with so many clients every week, prospective clients. And I'm sure it's something that auditors and the IRS is going to be aware of as well. But number one is inadequate record keeping. Simply just not having the transaction histories, especially if you're going back years and are on defunct exchanges. Lack of record keeping means an inability to substantiate your cost basis that is going to rely on any records that you're missing, which is going to lead to negative tax implications for you. So you want to make sure that you're keeping very good records. And one thing I even recommend to clients is downloading exchange files periodically throughout the year. Obviously, this is going to depend on how much you use an exchange. If this is some defunct exchange that you're going on on an isolated basis to just make one or two transactions, I'd probably download that transaction history right then, because you don't know what's going to happen with some of these exchanges, and you don't know if you're going to have access to your data in the future. And that's something that I've seen time and time again. So you want to be saving these records periodically, at least on a quarterly basis if it's an exchange you use more frequently. But we want to make sure that our record keeping is accurate and that we could substantiate all of these transactions that we're going to include in our accounting. And another big one is failure to document incomes, gains, and losses. So just not claiming the correct taxes for a transaction. Maybe you had an airdrop, you should have claimed it as income, and you didn't claim it as income. That's going to affect the taxability for the year in which you receive the income, but also in the year in which you sell the asset, because the cost basis and the income are going to be different. So we need to make sure that we're documenting this all appropriately and also with the correct accounting methodologies. If you apply the wrong accounting methodology either to your entire portfolio or to a specific asset, again, this is going to be something that can flow into subsequent tax years and impact your current tax year as well as future tax years. And choosing the incorrect accounting method or just applying a blanket accounting method to an entire portfolio other than FIFO is something that we see a lot, and that can cause large issues in your portfolio. So just making sure that you document and calculate appropriately your income, gains, and losses. Now, the next mistake is taking incorrect tax positions. I see this a ton when I'm talking to new or prospective clients when they come to Camusa CPA, either by researching online or from the advice of CPA firms that for whatever reason or they don't understand the nature of the taxpayer's transactions or just how the tax code relates to it, but they're just taking unreasonable, aggressive positions that do not meet the more likely than not standard. If you're taking these tax positions on your return, it's a recipe for disaster, because if you get audited, if you can't meet the more likely than not standard and substantiate that tax position, it's not going to be a good outcome for you. And like I said, I'm seeing a lot of people take unreasonable positions that a lot of people would call aggressive, but they're really just not reasonable, and they're not meeting the standards and disclosure requirements associated with your tax return. So this is another key, and this is another big mistake you want to avoid. And like I said, another huge one is tons of people come to our firm where sometimes they've done years of accounting and their ending cost basis data is inaccurate. Oftentimes it's not reviewed, or they don't even have the right reporting associated with it, where they don't have the detailed tax lot level reports. These are huge issues, and it shows a lack of integrity in the whole entire accounting system. So this is another huge mistake that you want to avoid. So one thing I touched on a little bit is selecting your accounting method, and this is key. Now, for accounting for digital assets, generally speaking, you have to account for them under FIFO, which is first in, first out, unless you meet specific requirements to claim specific identification. Now, what I see is a lot of people under the pretense of specific identification applying HIFO to their whole entire portfolio, but they're doing so in instances where they're not going to meet the requirements for specific identification related to their on-chain activity, with how they're managing their funds, and with the records and how they're substantiating this to the IRS is not going to coincide with the management of their funds. That is going to cause huge issues, and it's something that I've been seeing in reports that the IRS is starting to focus on in audits as well. So you want to make sure that you're selecting the correct accounting method, not only for your entire portfolio, but on an asset by asset basis. And if you're going to apply an accounting method other than FIFO, which is going to be specific identification, that you need to not only substantiate that, but manage your assets on chain in a way where you can be able to claim this and document it appropriately. And what I'm seeing is there's a lot of people that are just blanket electing HIFO, not managing their funds appropriately, and the accounting records they produce ultimately are not going to be accurate to stand up to an audit when it's compared to their on-chain activity. So once we have taken those steps and these considerations, what's the next step to really protect yourself from an audit? It's gathering the necessary documentation and record keeping. Now, part of this, we can leverage subledgers and digital asset accounting softwares, but you need to be in the driver's seat of this process, and some of this will happen within these softwares, some of this will happen without them. So number one is you want an audit trail for every single transaction. So if you're showing that you have a gain or loss on a specific asset you sold, you're going to want to have a trail of where that was purchased, where it was transferred, where it was eventually sold. So if audited, we can trace this whole entire flow of transactions back to show where this was originally purchased, or how much, when it was purchased, as well as all the associated information for when it was sold. We want that audit trail for every asset across your gain and loss, your spending, your income, as well as your cost base. So having this audit trail is key, along with making sure you retain a full history of all of your consolidated transactions once you've bought them all together. And by consolidated transactions, I mean your full transaction history across all your wallets, all your exchanges. The next important piece of documentation that I see a lot of people missing is the detailed tax level cost basis report. That's going to show all the assets that you're holding at the end of the tax period as calculated by you. This should be compared to your actuals in your due diligence process so it's accurate. And then you should be saving this report. This report is going to be a tool for you for tax planning purposes, so you can understand your tax positions, but also if you want to switch accounting softwares, or if you want to switch accountants or CPA firms, you are going to want this report so you can roll this over into the next accounting system, rather than having to rework all of your transactions all over again if you don't have this report. So I see this go overlooked a lot. I see a lot of people just not save this report, and it's going to cause issues for them. Similarly, when you're getting onboarded into an accounting software, you want to make sure that they provide this reporting as well, so you're not stuck sinking time into an accounting system that doesn't give you the reporting that you need once it's all said and done. And like I said, we want contemporaneous documentation on accounting and tax positions, especially for tax positions where the overall tax implications may be unclear. We want to document these appropriately so we have a basis for our tax position if we do get audited. So this is key. Now, one thing I see is that a lot of people will get on a crypto software or a subledger, do all of their accounting in it, and not save any of their reporting from it. Or sometimes even work with a CPA, have them do all the accounting, and then not save the reporting from it. You want to avoid this mistake as well. You want all of this stuff saved in your personal permanent documentation. So when you get audited, you really should open up a folder, open up a zip file, and have everything that you need. You don't want to be scrambling, reaching out to software, trying to find their login, trying to hope your CPA answers your email, or whatever the case may be. You want to have this information. You always want to control your data So you have optionality and you're able to always have what you need in the case of an audit. Another key to avoiding audits is once you've taken all these steps with accurately doing your accounting, you need to reconcile your accounting with any 1099s that you receive for tax reporting purposes. So 1099s you may receive from third parties that paid you in crypto, or you may receive 1099s from exchanges where you've transacted on an exchange over certain thresholds and they're filing 1099s to reflect your activity on these exchanges. So number one, oftentimes these 1099s can be inaccurate because they don't have your full cost basis information. We want to reconcile those so we get them accurate and we get them in congruence with our accounting records. This is important for a few reasons because obviously we need to report it accurately. But if these are incongruent and they're not reconciled, you may report your 1099 and your accounting and overstate your income, or you may leave one off and understate your income. Or if you don't report the 1099, but you report your accounting accurately, you can get a tax notice because the IRS is still under the assumption that you haven't reported this information from your 1099. So the key is that you need to report your 1099, you need to report your accounting information, but these two items need to be reconciled appropriately. So ultimately, you're reporting the 1099 to the IRS, but you're reporting the accurate amounts of your transactions and of your overall taxes owed. So this is key. I see a ton of people overlook the 1099s and then they're getting tax notices saying they haven't claimed their crypto activity, when in many cases they just didn't reconcile this against the 1099s. Other times I see people who get these 1099s and they simply just haven't filed the 1099, so they get tax notices. Other times people file the 1099s, but they don't reconcile it with their accounting. And like I said, this can overstate or understate your taxes. So it's just important that you get this fully accurate and that you include this in your tax reporting. So lastly, the last step that I would suggest taking when, trying to prepare for an audit and hopefully avoid an IRS audit is working closely with an experienced CPA that understands cryptocurrency. They're going to help you understand the correct tax positions for any transactions that may not be totally clear from a tax perspective. They're going to also help you take the correct steps in addressing potential red flags with any of your transactions where you may be missing data or cost basis information. And most importantly, the regulatory landscape and the overall tax implications to transacting in digital assets is rapidly evolving. We've already seen increased focus from regulators, and this is just increasing as we move forward. So as we start to see more and more tax law changes at the federal and state level related to digital assets, it's imperative that you work with a CPA that's on top of these changes so they can make you aware of these changes. So when you're out there transacting on chain, you understand the full tax implications to any transaction that you make. So are you looking to get an accounting system and tax system in order to make sure that you're in shape for a digital asset tax audit? Or are you currently being audited or have received a tax notice from the IRS? If so, look no further than Camuso's CPA. We can help you address your tax notices, work with the IRS to resolve any tax issues with them, as well as handling all of your digital asset accounting and tax preparation needs. So reach out to me and my team at CamusoCPA.com. I'd be happy to get you on the schedule, speak with me directly to see how we can help you out. Until next time, I'm Patrick Camuso, signing off.